Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, October 20th, 2018, and this is the weekly report. So right off the bat, this is a chart of Berkeley Energia, which is a uranium development company who has its primary asset in Spain. Now, I do not follow this company very much just because I've just really had no interest in it. And it's going to become obvious why I'm talking about it and why I didn't have any interest in it before. Several people have emailed me about this in the past. I just didn't even look at it. And the reason why is why would I be interested in a company that's trying to develop an open cast uranium mine in Spain? There are no uranium mines in Europe. Europe is the center point of the black hole that is the state control of everything: socialism, left-leaning politics, environmentalism. I don't go there. I've talked about this in the past, about permitting being an extreme issue in mining, not just uranium mining, but any type of mining or development. I mean, I followed a gold company, I can't even remember the name of it now, that's been trying to develop a 10 or 15 million ounce gold deposit in Romania for like 25 years. And the federal government there, over the protests of the local villagers and government, has refused to allow that mine to move forward. And this is going to be the same thing here. From the news reports I've read, a lot of the locals want jobs and want the benefits of having the mine. But, you're just simply not, I mean, you're already in a hard business, which is mining and trying to get things permitted. And then you go to one of the hardest areas in the world to get things permitted. The odds just weren't there. And now that's finally manifested itself this week when the company basically came out several days before and said things were looking good in an update, and then basically got body slammed 2 days later when the local government was told by the federal government in Spain, well, there's missing a couple of things here. This is how it works. They don't really come out and just tell you, we're not really jazzed up about uranium mining in Spain at the federal level. So instead of just saying that, they'll create all these permit hurdles that will never be able to be resolved, ever. And you'll jump through one flaming hoop. It's like David Letterman's stupid pet tricks. You'll just jump through all these stupid little hoops to put this little puppet show on for the government when they have no intent of ever permitting your project. Now, I'm not saying that that's going to happen here. I would say that they've said they're not going to, that there's some issues and they need to resolve them. But this is what I've heard before. All over the world, this is what governments say. They're not going to just come out and say, we're just really not going to ever approve a uranium mine in Spain. So this is what you have. It's a chart of the stock. It basically got clipped for about 50%. It started to come back. I don't know. I don't think it's fully resolved. I don't know the whole news. I didn't spend a lot of time on this just because why would I? I mean, there's just no reason to. You shouldn't own this stock, but people do. But this is what I'm talking about knowing risk and knowing what you own. I mean, here's the quote from the Reuters article. Basically, I just put a few notes here. The EU has no history of uranium mining in Europe. I mean, this is not what they do. I did see from the article one of the investors in the company, which I believe is a larger Japanese or Asian-based trading house, basically said, well, permit risk was always there. Okay. Did investors disregard or misprice this risk? I don't know. Why did people think this project would get approved in the EU in the first place? That's something I don't really know either. Maybe somebody that owned it can write me and tell me why they thought that a uranium mine would get approved in the EU. The other question is, or the other note I made here is, I just want to put this, I'm not going to get into specifics, which I can't because of just the responsibility I have to Actionable Intelligence Alert newsletter customers. When it comes to uranium, I stick to the Athabasca region of Canada and Namibia. And the reason why is because these places have a history of uranium mining. They have a constituency for it. When I say that, in Spain, they showed a picture of like 1,000 villagers that were saying they were for it. I mean, if you go to Canada, uranium mining, Cameco's based there. It's the second largest integrated uranium nuclear fuels company in the world. The federal government, Justin Trudeau's government, may not like nuclear power. They're simply not going to, get in the way of it too much, just because there's so many people whose livelihoods and there's so much money behind it. And the same thing in Namibia. I mean, Namibia is a fairly stable southwestern African country. It has a long history of uranium mining and exploration. The government relies on it for tax revenue. They're going to be more apt to approve and want to encourage further development. And that's what they have been doing. So I think you really need to understand, especially with these juniors. I mean, I think with Berkeley, this was their only project, so they're basically knocked out of the box. I mean, what's the company worth if their only project doesn't move forward or doesn't have any ability to move forward? Like I said, there was this company in Romania that's been trying to develop this very lucrative deposit of gold for 25 years and just hasn't been able to do it. So I kind of see the same thing happening here with Berkeley, although no one can know for certain the future. So you're just increasing the risk on yourself by owning something like this when you don't have to do that. That's the whole point of this discussion. There's other names you could have been buying, and you can buy, that have less permitting risk. And that's just one of the many risks that are out there when you're dealing with mining, especially uranium mining. So let's shift over to oil. There's a blog I follow. It's called the oilystuffblog.com. You see it here. The person that runs that has demonstrated to me at least over the time, that they are very well educated on how the oil markets work. And I'm not just talking about from an investor or analyst perspective, but I think this person actually has a lot of background in the oil field at all levels. So this person had a article that came out yesterday. It was called Deep the Denial, and had a picture at the start of the article of a school of mackerel. And that was a metaphor for the view of shale oil in the United States and the fantasy that it is that we're going to be energy independent, and what that whole little fantasy and story is based on. And I think it's a required reading if you're invested in the oil markets, because it's I'm more and more developing this thesis that we are going to have a oil supply crunch in the future. I think is going to raise oil prices significantly higher than most people think. Now, this is more of a longer term call. Obviously, in the short term, no one can predict what's going to happen with the oil price in the next month or 2 or 3 months. But I think over the next 3 to 5 years, we are going to have a massive oil crunch and energy crunch around petroleum, just because of the overstating of the shale phenomenon in the United States. That's really covered up a lot of other geological and financial characteristics that are going to manifest themselves as we go forward. Basically, in the article, I'm just going to summarize. I suggest you read it. Basically, the USA now is producing 11 million barrels per day. But to get this tremendous amount of growth in shale oil, which basically more than doubled U.S. oil production over the last 10 years, this required $285 to $300 billion of debt, of which $240 billion of it matures over the next 5 years. Now, why I think this is important is because I've shown over and over that, with very few exceptions, most of these companies that are operating in these shale basins have simply not been able to make money. Not only have they not been able to make money, they haven't even earned their cost of capital. They are unable to cash flow enough cash to pay the interest on the debt that was required to drill the wells, much less pay the debt off and and generate some type of return for shareholders. I will quote from the article: using its own self-touted break-even oil price, the shale industry must produce over 1.5 million barrels a day just to pay interest on the debt each year. Those are barrels of oil which cannot be used to deleverage debt, grow reserves, nor even replace reserves that are declining at rates of 28 to 15% per year. That is just what it will take to service the debt. Now, the problem is that we are in a rate cycle, upcycle. Interest rates are going up. It will become, number one, more difficult to refinance existing debts and roll those debts, if you will. It will become more difficult to get new debt issued, because we're going to go into a situation where as interest rates go up, things are going to start to break. And I've said this before, and I need to talk about this more going forward. When I say things are going to break, we have a lot of zombie companies out that have been propped up by low interest rates. And as interest rates go up and people are forced to refinance, it's going to become more difficult to do that. The cash flows that are being generated by the business that's to be refinanced simply won't be sufficient to do that. Those companies will go bankrupt. Once that cycle begins, liquidity and financing will dry up immediately for everybody else. It'll become more difficult even for good operators that can generate cash flow and can service their debt. It will even become difficult for them. So you couple this with the fact that, oil is, we could even go into a recession. I think over the next year or two, we're going to be looking at more of a potential for a recession. But those oil declines are still there. Even if the economy was to contract by 1 or 2%, you still have millions of people driving every day. You still have that depletion that's working on you 5 to 6% a year. And if you're not, and we've already talked about this dearth of investment that's taken place in new production over the last 4 years. That treadmill doesn't stop. And if you make it more difficult by the fact that interest rates go up and it makes it more difficult for financing to happen, that's going to have an effect on future supply. Now, I put one more comment in here, and I've said this before. I've seen other people say it too. It's not like I came up with this idea, but I've said this all along. I mean, the U.S. shale miracle was and is a manifestation of historic low rates, low interest rates, and easy access to cheap money. It's very similar to what happened with the housing market circa 2007, 2008. Interest rates were low. We had this housing bubble develop, and it grew and grew and grew, and the amount of debt and the fact that rates were so low and that you had these very creative financings, like I said, watch The Big Short or read the book, led to an oversupply of housing, and then we all know what happened. So I think you're going to see something similar happen here. I don't think that U.S. shale is the long-term panacea. The United States is not and will not ever be energy independent vis-a-vis hydrocarbons. It's just simply not going to happen. There's not enough capital, cheap capital. He goes into the article later to say that just based on the calculations that he did, or this person did, and I'm not suggesting, I've seen these numbers other places. I just bring the news to you and bring these ideas out. In order for the majority, let's just say the industry as a whole, in these shale basins to actually pay back their debt, and they need a price of about a sustained price of $125 a barrel to make this work. That simply isn't going to happen. That would break the world economy. Yes, you could have a spike to 125, but you need oil prices to go to 125 and stay there for several years for this thing to work itself out. I don't think that's going to happen. So, staying on this theme, Schlumberger, which is probably the biggest and best oil field services company in the world, recently had their quarterly report. I pulled out some information. I suggest you look at it. I'll put a quote to the previous article about shale, but I'll also put a link to this transcript for this conference call. People ask me, John, how do you get your information? How do you do your research? This is what I do. If you want to know about the oil market, you should be listening to the oil field services providers, i.e. this is the top one in the world, and they have their finger on the pulse everywhere. They get all the data. Believe me, they know the majority of wells, how they perform, what's going on in these different basins, the costs. These guys have got it dicked, okay? So if you want a pro tip and you want to know what's going on, you've got to be into this. You've got to spend some time instead of going to the club on Friday or, hanging out with your buddies watching college football all day Saturday. If you want to be successful in these markets, you have to get into this research and try to figure out what's going on in real time, and what's the real story. Or you could just subscribe to the Actionable Intelligence Alert, and I'll do that work for you. Anyways, getting back to the quarterly report, I thought it was interesting, kind of hit on some themes that we've been talking about in the past. Let's get right into this. international production base now needs significant growth in investments for the foreseeable future simply to maintain production flat at current levels. I think that's kind of the whole thesis, mission statement for my investment in oil field services and into this oil market, if you will. We've talked about it many, many times on these videos and in the newsletter that there simply has not been sufficient investment in new production to not only make up for the ongoing depletion that goes on every year, but to account for the new growth in demand, which, regardless of the EV revolution, all this, I mean, demand still goes up by about 1 to 1.5% a year for oil. Considering the fact that we're at 100 million barrels a day in production, you need to bring on another 1 million to 1.5 million barrels a day of new production per year. Otherwise, the price will go up. And that's what's happening because of the insufficient investments. Now you have the largest oil field services company saying that also. These are more quotes. I'll just read them and comment. However, what is already clear to us is that unit well. This is transitioning. Now let me just set this up. So, in the transcript, if you read it, the CEO talks about the different basins around the world, the different themes, and he's getting into talking about the U.S. shale. Now, this is what he'll be talking about. The Eagle Ford Shale here and what he calls child wells. These are the infill locations between the first generation of wells that were drilled. Now you have to remember, when you go into an oil field, you're going to be cherry picking the best locations. So then you start getting into the second and third generation infill drilling. Those are not as productive wells. And let's see what the #1 oil field services provider in the world says about that. It says, what is already clear to us is that the unit well performance normalized for lateral length and pounds of proppant pumped is dropping in the Eagle Ford as the percentage of child wells continues to increase. Well, this is obvious. You've already produced, you've already drilled and brought onto production the prime locations. I mean, they have the data, they do the surveying, they know the best locations. Obviously, you're going to go drill those first because those have the highest return on capital. They start depleting, you have to start going into the less prospective areas, i.e. the infilling, the child wells. And what are we seeing from those? They're not as productive. Oh my goodness. You mean it's not a cornucopia of unlimited oil in these basins? No, it's not. So going on. Today, the percentage of child wells drilled in the Eagle Ford has already reached 70%. And in the 3-year period since this percentage broke the 50% level, we have seen a steady reduction in unit well productivity. So as they got over 50% of the wells being drilled being child wells, they've seen steady reduction in unit well productivity. Well, that can be extrapolated onto other fields, i.e. the Permian Basin, which is in West Texas, which is everybody's pinning their hopes on. It goes on to say, in the Permian, the percentage of child wells in the Midland Wolfcamp Basin has just reached 50%. And we are already starting to see a similar reduction in unit well productivity to that already seen in the Eagle Ford. Oh, so you mean that geology and production statistics are similar across different basins? That's interesting. Going on, we believe that the level of E&P, that means exploration and production investment, must increase both internationally and in North America, first of all to counter the multi-year drop in investments, and second to develop and deploy the new technologies needed to overcome the emerging shale oil production challenges. So there you got it, right from the horse's mouth, the people that provide the services, that have all the data, they're telling you what needs to happen. You juxtapose that against the fact that the whole thing is a mirage based on cheap credit and historic low interest rates, and this is a recipe for a disaster. There simply has not been enough investment. The investment that has been made has been kind of wasted, in my mind. It was all based on debt, kind of like the housing market that blew up in 2008. Based on cheap money, and now this mirage is getting, as you get closer to the so-called oasis in the desert, it's going to disappear like a fart in the wind. What that means for us is that I'm going to be looking at more and more of these large international oil companies, these Seven Sisters types, and some of the larger independents like Anadarko and Apache, and see where they're going to be going with their dollars. I'm starting to see more interest now. We're starting to see offshore pick up. We've seen a lot of these things start to turn now. The offshore drillers, service providers, And I think that they're going to have no option but to continue offshore and into more difficult areas of the world. I mean, guys, we've had a little 5 to 10 year respite because of low interest rates, where we had this shale revolution that basically bailed us out. Now the piper's coming down. The piper needs to be paid, and I think this represents a tremendous investment opportunity, speculation opportunity. Wanted to touch on a little bit about the discussion I had last week, where I put out the little trade idea, which it's down 5% already, but nothing to worry about. Differentials are going to close. I mean, let's review that. I suggested that people should go. What I'm doing is I see the differentials between West Texas Intermediate crude and Western Canadian Select are at historic highs. That's because of the refining season and the amount of refining capacity that's been taken off for turnarounds. Turnarounds being the fact that you have to go set your refinery up from summer blends to winter blends, do maintenance and upgrades, whatever you need to do. So you basically are shutting most parts of the refinery down, and you usually do that over a 4 to 6 week period, and do maintenance. Well, you're not processing crude during that time. So typically during turnaround season, you see 700 to 750,000 barrels per day of oil demand go away during that season. This year was 1.1 million barrels. So we've simply seen the spread. The oil is getting trapped in Canada. When we say Western Canadian Select, it's a benchmark price for Canadian crude. It's basically the crude is getting trapped and piling up in Canada. They don't have enough takeaway capacity there or other outlets for it. So the price has crashed while the price of oil and WTI has fallen, but not as much. Obviously, these turnarounds will end, and we will see them begin to take crude out of storage. We should see the differentials begin to close again to their historic norms over the next several months. That represents a trading opportunity, as I alluded to in the previous video from last week. And if you're interested, you can go check it, to buy an ETF that represents this specific crude, which is the Canadian crude. So what we should see over the next several weeks or months is see the refineries come back online, specifically the one right here in Chicago, Whiting Refinery, Whiting Refinery, that takes almost 10% of Canadian crude. It should be coming out of turnaround in the next couple weeks. So that's I believe, a excellent trading opportunity, and I laid that out last week. Check that out. But long term, guys, the oil price has to go higher to stimulate sufficient new supply. We've talked about that ad infinitum. I'm not going to keep going on about that. So I thought this is interesting, though, what we're seeing, more and more discussion around not only just anecdotally, but now people are saying it in these big companies that provide the services. They're saying something similar to what we've been saying for some time. So that's it for this week, guys. Continue to thank you for the support. If you are interested, you can subscribe to the Actionable Intelligence Alert newsletter. I put a note on how to do that in the show notes. Also, my Patreon. I put a lot of work into these videos. Some people choose to support me for that, kind of like Michelangelo was supported by patrons to do the Sistine Chapel. That's kind of how it works. If you do decide to do that, if you give a donation of $5 a month or just a one-time donation, I will send you a sample copy, one-time sample copy of the Actionable Intelligence Alert current month stock picks. That way you can get a flavor of what kind of stocks and what kind of things we're looking at in the newsletter. If you choose to do neither and you just want to be a free rider, at least please subscribe to the channel. My videos, I think they're informative. We get a lot of good feedback on it. Hit that bell. That kind of stuff helps me out. If I can get over 1,000 subscribers, that's kind of a break level where certain things can happen for me SEO wise and inside YouTube. So if you're just a cheap guy and don't want to, cheap Charlie, and don't want to subscribe, that's fine. No worries there. It's not for everybody, but hit that support there on that bell and that subscribe button. So I definitely appreciate it, guys. Plenty of great feedback. Love you guys. You guys really support me. really good comments. I'm not an egomaniac, but when people tell me that they're getting value for the things that I'm doing, it does motivate me to keep going. So again, thanks for that. We'll talk to you next week, guys.